Vanguard Australia just launched 2 brand new ETFs, one built for income, the other for pure growth. But should you actually invest in them? New ETFs can be tricky since there's not much historical data to rely on, but don't worry, I've done the research for you. In this video, I'll break down these 2 ETFs, compare them with Vanguard's existing diversified ETFs, and help you decide whether they deserve a spot in your portfolio. Before we dive in, if you enjoy videos about investing and personal finance, make sure to hit that like button and subscribe. It really helps the channel grow and lets me keep bringing you more content like this. Alright, let's get into it. Vanguard Australia has introduced 2 new ETFs, Vanguard Diversified Income ETFs, VDIF, Vanguard Diversified All Growth Index ETF, VDAL. The All Growth ETF VDAL sticks to the same 0.27% annual management fee as the other 4 diversified Vanguard ETFs, but the Income ETF VDIF comes with a slightly higher 0.32% fee, likely due to the broader range of holdings. We'll break that down in a bit. Among Vanguard's 71 funds and ETFs in Australia, they can be grouped into either single sector funds focused on one asset type like shares or bonds, or ready-made diversified options, pre-mixed portfolios of different assets. Before March 2025, there were 4 diversified ETFs and matching managed funds ranked by risk levels: conservative 70%, defensive 30%, growth, balanced 50-50%, growth 30%, 70%, high growth 10% and 90%. Each ETF charges 0.27%, while the managed fund version charges 0.29%. The most popular option is the growth option with a total fund size ETF plus managed fund of 12.4 billion. Building a portfolio is all about balancing growth assets like stocks, private equity, infrastructure with defensive assets like bonds, cash, and gold. But here's an interesting gap. The jump from balance 50-50 to growth 30-70 leaves a 40-60 allocation missing. And guess who was a huge advocate for these exact 40-60 split? John Bogle, the founder of Vanguard. Bogle often recommends 40% defensive and 60% growth using just 2 asset class index funds, a US total bond market index fund and a US total stock market index fund. In fact, when I compare Bogle's classic 40-60 portfolio against 7 other diversified strategies in one of my videos, it ranked among the top 3 in total returns and had the second highest Sharpe ratio, meaning better risk-adjusted returns than even Warren Buffett's 1090 portfolio. Honestly, Vanguard Diversified Income ETF VDIF should have been introduced a long time ago. This overdue addition fills the gap. It has a 40-60 defensive to growth allocation and a medium risk. The more growth assets a portfolio tilts towards, the more uncertain the return it will be. In other words, it's more likely to have major price fluctuations or riskier. The risks from conservative option to high growth options pretty much follow this rule. Their standard deviation, which is a major indicator to measure how volatile the portfolio is, go from 6.78% to 8.41%, from 9.63% to 10.95%. But we have to understand higher volatility doesn't always equal higher return. But since Vanguard's ETFs track broad market indices and markets tend to go up over time, this kind of long-term investing usually works if you can handle the ride from time to time. Because of this volatility, Vanguard suggests different investment horizons for each risk level: conservative 3+ years, balanced 5+ years, growth and high growth 7+ years. Now let's talk about the Vanguard's new All Growth ETF VDAL. This one is at the riskier end of the spectrum because it completely removes defensive assets. No bonds, no cash, just pure stocks. That means it's not diversified in terms of asset classes, but geographically. When choosing an ETF, risk tolerance and investment horizon are important, but most investors care most about past performance. Since these 2 ETFs don't have any track record yet, we can't directly measure their returns, but don't worry, I'll show you how we can estimate them later. For now, let's take a look at how Vanguard's existing 4 diversified ETFs have performed over time. Total returns come from 2 parts: income return, dividends, distributions paid out; price return, how much the ETF's price has gone up or down. Total return equals income return plus price return. According to Vanguard's historical data, assuming all income distributions were reinvested, after allowing for management fees, excluding brokerage costs. Here's how the income return looks for each ETF since inception. All dividends are paid out quarterly. Now, normally you'd expect defensive assets like bonds to provide more income, but in these portfolios, the more growth assets you add, the higher the income return it becomes. A little unexpected. Since growth assets shares generally increase in value over time, the more growth assets in a portfolio, the higher the price return should be. Let's check if that logic holds. Conservative 1.1% price return, balanced 2.08%, growth 3.49%, and high growth 3.48% price return. So yes, we do see a general trend where portfolios with more stocks tend to have stronger price returns over time. If you had invested $10,000 5 years ago, here's what you have today. How do we estimate the returns of these two new ETFs? The answer lies in their underlying holdings, and that's exactly how we're going to dig into next. Vanguard's diversified ETFs are funds of funds, meaning they are built using other Vanguard funds. For example, the high growth ETF, which is 90% shares, 10% bonds, is made up of 36% Australian shares, mostly from VAN 0002AU with a tiny bit of VAS, the well-known ASX 300 ETF, 5% emerging market shares, VAN 0005AU, 16% international shares, hedged VAN 0105AU, plus a tiny of VGAD, Vanguard's hedged global shares ETF, 26.5% international shares, VAN 0003AU, plus a small portion of VGS, Vanguard's unhedged global shares, another popular ETF, 6.5% international small companies, VAN 0021AU, and some VISM, Vanguard small cap ETF. The 10% defensive allocation includes 3% in Australian fixed interest, VAN 0001AU, plus VF, 7% international fixed interest hedged, VAN 9309AU, plus VBND. The other three diversified options use the same building blocks, except the conservative ETF also includes 10% cash for extra stability. The new Vanguard Diversified Income ETF VDIF takes a different approach. It looks a lot like the core 4 portfolio, a strategy that balances stocks, bonds, and real estate. Its 60% growth assets include no emerging markets or small caps. Instead, it adds 5% international property hedged, likely VAN 0019AU, and 2% Australian property, probably VAN 0004AU or VAP. Its 40% defensive assets are more complex. Instead of the usual Australian and international bond funds, it includes 17% international credit hedged, likely to be VAN 0106AU or VCF, 11% international treasury, likely to be VAN 0103AU or VIF, 7% Australian credit, corporate bonds, likely to be VAN 0065AU or VACF, 5% Australian government bonds, likely to be VAN 0025AU or VGB. So instead of 6 to 7 underlying funds like the other old diversified ETFs, the income ETF has 9. Maybe that's why Vanguard charges a slightly higher fee, more funds, more admin work. Now that we know what other two ETFs are made of, and we know the income return and price return of the underlying funds, we can easily calculate the two ETFs' income return, price return, and the total return by using this formula. So is VDIF the right choice for you? If you don't need access to your money within the next 5 years and want a well-diversified portfolio but don't want to settle for super low returns, VDIF could be a better option than the conservative or balanced ETFs. But if you are nowhere near retirement and have a longer time horizon, you're probably better off with high growth VDHG or even all growth VDAL if you're focused on total returns. And if you're mainly after dividends, an all equity ETF like VHY might actually provide higher income yields while still delivering similar price returns over the long run. At the end of the day, VDIF is a middle ground option, a good compromise if you need some income but still want decent growth, especially if your investment timeline is shorter. Now, what about all growth VDAL? Is it worth switching from high growth VDHG? If you look closely, the only real difference between high growth and all growth is that all growth ditches the 10% bond allocation and puts that money into 5% more Australian shares, VAS, and 5% more international shares, VGS. So if you're already investing in high growth VDHG, that means you likely have a high risk tolerance and a long investment horizon. The real question is, are you okay with more volatility in exchange for slightly better long-term returns? The bonds in high growth aren't there to increase returns. They are there to smooth out the ride. Here's a chart showing the performance of global equities versus global bonds from 2001 to 2022. Stocks are volatile, they swing up and down. Bonds are much smoother and more predictable. They act as a buffer during market crashes. If you're comfortable seeing your portfolio drops 5.6%, 8%, or even 10% in the short term, like right now as of shooting, then all growth might be the better option for maximizing total return. But if those kinds of swings stress you out, it's probably better to keep some bonds to stabilize the ship. By the way, that was VGS, IVV, and NDQ. One last thing to consider, Vanguard's target asset allocation might not suit your personal preferences. For example, in All Growth VDAL, the Australian versus international stock split is 40-60, but you might prefer 30-70. With the international stocks, you have exposure to emerging markets and small companies, but maybe you don't want that. If you like full control over your asset allocation, it might make more sense to build your own portfolio instead of using VDAL. So what do you think of Vanguard's 2 new ETFs? Are they worth investing in, or would you stick with other options? Let me know in the comments. I'm Irene, see you next week.